Hello, and welcome to today's webinar. I'm Mason Longstreth, Director of Tax and Partner at TFO Family Office Partners. Joining me is my colleague Spencer Wright, one of our family tax strategists. We're glad that you could be with us today as we provide an overview of the One Big Beautiful Bill Act, which we're going to shorten down to OBBBA, which isn't that much better, but it's a couple syllables. So, well, anyway, we'll be discussing the key tax provisions and the planning implications for individuals and businesses. Before proceeding, I'd like to take care of some housekeeping. Thank you, Spencer. We have a few housekeeping items. Today's event is a webinar. By default, all attendees are muted and have their videos turned off. Today's event is being recorded, and a recording of the webinar will be available later. At the bottom of your screen, you'll see a Q&A icon. If you have any questions during the event today, please use that feature to submit them. I'm looking forward to seeing what questions we get. We will save time at the end of the webinar to answer as many of those questions as we can. If something comes to mind after the webinar, please feel free to reach out to your TFO team to answer them. So what we'd like to talk about today, and really what we're focusing on, is the relevant provisions of the OBBBA that are relevant to the families that we work with. So we're not going to go into a lot of the detail that are non-tax provision related, and maybe we'll skip on some of the stuff that may not apply to high net worth individuals. Again, the bill was 800 pages long, and we only have about an hour today to discuss, and so we can't get into all that detail. I think from high level, a few of the themes that we see is that this is really, there's not really much of a unifying theme to this piece of legislation. It's really a mixed bag with a bunch of different start dates and stop dates. And that's something that you'll see as we go through the laws. I think there's a belief that the law changed and these are the provisions are in place. But really what you'll see is that the start dates of some of these provisions are beginning of this year, some of them are now, some of them are at the end of the year, and some of them are not even until next year or the year after. I think the one thing that we see is it's added a lot of complexity as well to the already complex tax code. So it emphasizes the need to talk about transactions or things that are going on in your life with your engagement team before they happen or kind of current when they happen, because the old rules of thumb that we've used in the past to kind of like eyeball or guess what the tax benefit is. If you're looking at, like, I've made a deduction of X dollar amount, I expect this kind of tax benefit. Those rules of thumb are kind of gone at this point. There's just too many different layers and too many competing thresholds and limitations that could apply that you really need to model it out and find out what the answer is. And then finally, we're going to clear up some misconceptions, because I think there's been multiple iterations of this bill as it was coming up to be passed. And some of the provisions changed along the way, and the media outlets haven't necessarily notified the public of those changes. So that's one of the other things that we'll cover. I think the three key components of the act is you'll see extensions of existing legislation from the Tax Cuts and Jobs Act. That was the law that went into place in 2018, the first Trump era tax cuts. So some of those things were extended, some of them were enhanced. There's also some new deductions and new tax advantage savings opportunities that are kind of just brand new with this legislation. And then you'll see some meaningful updates for estate taxes, businesses, and for family office planning tools that we use all the time. So Spencer will be covering a lot of the individual provisions, and I will come back after him and cover the business tax provisions. So Spencer, I'll turn it over to you.
Thanks, Mason. So in order to understand the OBBBA, you have to go back to 2017 with the TCJA. That's too many acronyms for me, but that's what we were dealt. So going to the TCJA, there were a lot of tax incentives that were passed and changes that were made. And when they made that in 2017, there was what they call a sunset in 2026. So they implemented all these changes in 2017 and said, okay, but in 2026, everything's going to go back to the way that it was. So they were calling this the big sunset. One of the things that people were afraid of in that sunset was the top marginal income tax rate. It used to be 39.6%. And now with the TCJA and the extension, it's now 37% permanently. Uh, this OBBBA bill extends some of the TCA provisions, a lot of them. For some, it extends them a little bit longer. For some, it's permanent. But had these provisions been allowed to expire, there would have been an estimated 62% of taxpayers that would have faced an increase in tax. So they said, we got to do something. We got to either extend it or make some changes. One of the large sunsets, or one of the big worries, was the estate and gift tax changes. So, along with income tax, sales tax, and all these other types of tax, there's a thing called transfer tax. And the government allows you to transfer wealth of only a certain amount. And then after that amount, it's taxed at 40%. Well, before TCJA, that amount was $7 or $8 million. They said you can gift or you can pass away with $7 or $8 million. After that, we're going to tax you at 40%. With the TCJA, they bumped that up to about 13 or 14 million. And a lot of people were scared because with the sunset, it was going to revert back to the 6 or 7 million that it was. And with the OBBBA, they permanently extended it to $15 million beginning January 1st, 2026. So a lot of people were scared about that, but it remained at 15 million. There were some other things at play or that were in question, like valuation discounts, certain types of trusts, but nothing has changed there. Now, I have said that it has remained at the $15 million, and some people can take a big sigh of relief, but that doesn't mean that you don't have to do estate planning. You might not have to pay estate tax, but we definitely recommend doing your estate planning now. And some of those strategies are through certain types of trusts that we'll talk about next. Some interesting statistics. These are the amount of estate tax returns that were filed. I have filed, so I've been a CPA for, let's call it 15 years. I've probably done only 15 to 20 estate tax returns in my whole career. So not a lot of people file these. And in fact, the number of returns, if you look at 2017, the number of estate tax returns was 11,300, and only about half of those, or 5,500, were taxable estates, and it generated revenue of $20 billion. After the TCJA, of course, when the lifetime exemption bumped up to 15 million, the amount of returns that were required to be filed decreased substantially. So another point is the revenue that's generated through this tax. I know $24 billion is chump change for Mason here, but for the government, as far as tax revenue, it is a fraction of a percentage of tax revenue. So even if you bumped up the estate tax to 60% or subjected people at 7 or 8 million, it's not going to move the needle too much. Some of the strategies that we implement with our clients are certain types of trusts, like slats or BIDETs. I won't get into the nitty-gritty of that, but some of the game that people play with these trusts is, how do I get these assets out of my estate, but yet still have some kind of access to it? Because yes, a very wealthy person can give away all of their assets and go and be homeless and say, great, I don't have to pay any estate tax, but that's not the goal. So there are certain trusts that you can set up to give away your assets, get it out of the estate, but yet still have some type of access to it. And that's done through careful planning and, of course, with an estate planning attorney. There's other strategies like basis adjustment planning and valuation discounts, which are still at play. Basis adjustment involves what is called the step up in basis when somebody passes away. If mom and dad bought a farm back in 1950 for $1,000 and a cow, that's their cost basis. And now let's say it's worth $1 million. Well, you know that if they sell that property, they're going to have a huge gain. Well, if they pass away with that farm included in their estate, the basis is stepped up to the fair market value on the date of death, which would be that $1 million. So there's obviously some games that you can play there, some strategies you can implement, and then valuation discounts using family partnerships is another strategy that still are very well much at play. One of the big things is what's called the SALT deduction, or state and local tax deduction. You may recall back in 2017 when the TCJA was implemented, they put a cap of $10,000, a maximum of $10,000 of a deduction you can take for your state income taxes, your real estate taxes, and your vehicle registration, taxes like that. People in California, New York, New Jersey were very, very upset because they pay a lot of income tax and their real estate taxes are very high. So when they were getting a $60,000, $50,000 deduction, after the TCJA, they were capped at 10,000. Well, with the OBBBA, they bumped that limit up to $40,000. But there is an income threshold. So, and that is $500,000 if you're married filing jointly, or $250,000 if you're single. So a lot of people were excited about this new $40,000 cap. However, if you make in excess of those amounts, it reverts back to the $10,000 limit. In order to combat this $10,000 limit, there was the implementation of the pass-through entity tax, which is a workaround the $10,000 cap. And without going too much into the weeds, basically you set up an entity, a partnership, or an S corporation, and that is what generates the income. And you pay the state income tax at the entity level. And because you paid it at the entity level, you are not subject to the $10,000 cap. And so this is, again, another strategy people have implemented and is still viable today. They didn't make any changes with that. So charitable deductions have changed slightly, I will say. Every year, I reach out to all my clients who are very responsive and get me all of their information very timely. And I ask for receipts for donations. Now, sometimes if I know the client is not going to itemize their deductions, they're going to take the standard deduction, I will pass on asking them about their charitable contributions, because your itemized deductions, that's where you give your CPA all of your charity, your medical, your home mortgage interest, and you get a deduction for all those things with some limitations. But if somebody was taking the standard deduction, I didn't need their receipts. But now I need their receipts. Even if you're taking the standard deduction, they will allow you to take a charitable contribution deduction up to $2,000 if you're using the standard deduction. So now I have to ask, all these people that aren't itemizing all of their for all their charitable receipts. There's also a new floor of 0.5%. We can almost call this a haircut, and it's best illustrated in this example. If your adjusted gross income, or AGI, is $1 million and you donated $50,000 of cash, the first $5,000 of that would be non-deductible. That's the haircut. And then the remaining $45,000 would be deductible. Not a huge change, but some people might be shocked when they look at their tax return and they say, Spencer, I donated $50,000, not $45,000. You got that wrong. Well, there's this new haircut that has been implemented. So the rule of thumb no longer applies, where you can do that back of the napkin calculation of, oh, you're in the highest tax bracket, 37%. Okay, you donated $100,000. That's $37,000 worth of tax that you saved. But now we can't do that. There's more hoops that you have to jump through, as Mason said in the beginning. As always, we recommend people to donate appreciated securities where appropriate. If the charity will accept publicly traded securities or stock, and they have, there's kind of a tax time bomb with those securities, it has very low basis, and you're going to sell it for a huge gain, perhaps the charity would take the securities as opposed to you selling the securities, recognizing the gain, and then giving the cash to the charity. So you can totally skip the tax bill on that huge gain. It's a strategy we often use. 529 expansion. It used to be for 529 plans, it was college tuition and room and board that you could pay for 529. You could utilize the 529 plans for. They've expanded this to now include uh, materials and books or online education or tutoring or even credentials and certifications. So if I was getting my CPA and I had fees associated with that, I could use my 529 plan to pay for that credentialing. Um, Also, if your kids are in private school, elementary school, junior high, high school, you can utilize up to $20,000 a year of the 529 plan for those expenses, those private school expenses. Some of the other notable provisions that have changed is the standard deduction. In 2024, it was about 27,000, 28,000. It's been increased for inflation to 31,500 if you're married filing joint. There's also an additional $6,000 deduction for seniors. And I believe if you're over 65, you're considered a senior, and it's per person. So if you and your spouse are over 65, you're married filing jointly, you'll get a $12,000 deduction, no questions asked. The child tax credit was raised from $2,000 to $2,200. The best advice I can give you today probably is don't have kids for tax purposes. It never works out. I've tried it 6 times. The math never maths. It never works out economically, so please don't. But hey, it's $200 extra that I'll be getting per kid. The 529 plan expansion we already covered. Another one is the car loan interest deduction, and this one I'm a little torn with because it's a $10,000 deduction and it's only for new cars that are assembled in the USA. Usually when the government gives a deduction or a credit, it's trying to incentivize people to do something like give to charity. I'm not sure. I get the incentive to go and buy new cars to stimulate the economy. That's great. But I'm not sure I would ever recommend somebody to go get a vehicle loan for the tax benefit. So the deduction is up to $10,000 and it is subject to income limitations. So if you make over a certain amount, $200,000, if you're married filing jointly, you get no benefit for it. So in order to pay for all of these deductions and credits that have now been implemented or extended, they've repealed a lot of the clean energy credits, which is like your Tesla or Rivian or what are electric vehicles, your EVs, your energy efficiency home improvements or solar. And I'll go to this next slide real quick. We've summarized the most common energy credits for individuals. Starting with the left, there's the previously owned clean vehicle credits, or like a Tesla I'll use for an example, and the clean vehicle credit for new vehicles. The maximum for the used vehicle, if you buy a used Tesla, let's call it, is $4,000. But it is subject to AGI limitations. So if you make too much money, you won't get a credit for it. And this expires September 30th. I've already heard on podcasts or radios or online, get your Tesla today. Credits expire by September 30th. Now, what they're not telling you is that there are income limitations. So if you make too much money, which I think it's over $300,000 for married filing joint, you won't see that credit. So just be aware that there are AGI limitations. But if you have a child or who's just earning their income, hey, if you're going to buy that Tesla, you better do it before September 30th to get your $7,500 if it's new. The other things are like the EV charging equipment. If you need a new charger for your electric vehicle, that's a maximum of $1,000, but it expires June 30th of 2026. And there is no income limitation. So you don't have to worry about that. The next two, well, I'll go over that first one. The energy efficient home improvements. That's your HVAC, your windows, your doors, your water heaters. Now, I say that they do have to qualify for the credit. So you can't just say, I bought a new HVAC, I get the credit. You have to make sure that that specific model and type qualify for the credit. And there's a website that determines whether it does or not. But that's all going away at the end of this year. So if you were going to buy an energy efficient HVAC, do it in 2025 rather than 2026. For the residential clean energy credit, that's more for like the bigger improvements like solar or battery storage. That is 30% of the cost. So if you paid $20,000 for a new solar, 30% of that, or $6,000, would be a tax credit you could take, but it ends at the end of this year, and it's not subject to income limits. So again, the solar companies are really touting this, saying, better get your credits now, better get your credits now, because this is going away. I'll go back to the slide at the bottom there where it says itemized deductions limitations for high income earners. We talked about how it's not as cut and dry anymore with the deductions and benefits someone will receive. If you're in the highest income tax bracket at 37%, they are going to limit the amount of benefit you can receive from all of your itemized deductions to 35%. So it used to be clients would come to us and say, I donated $100,000. I'm going to get a deduction or a tax benefit of $37,000 because I'm in the 37% tax bracket. Awesome. But now they're limiting that to only a benefit of 35%. So you'd only get a tax benefit of $35,000 in my example. Some other things, smaller things, is the HSA changes. There's more things that are eligible that you can utilize your HSA, like a gym membership, and some other new expenses. Not a huge deal, but just interesting. The itemized deductions, which a lot of our clients pay these, what are called miscellaneous 2% itemized deductions. Those are your investment expenses that you pay your investment broker or any investment expense really. Before the TCJA, you could take a deduction for those after a 2% hurdle of your adjusted gross income. And then the TCJA was passed and they said, nope, you can't take a deduction for them anymore. And they've extended that. They are still no longer deductible. However, we have some families that pay a lot of these fees, investment fees. There are certain types of structures you can implement, especially with a family office, that can make these fees deductible. I won't go into the details of that, but it requires a pretty extensive restructuring and family partnerships and a family office structure, but it is something we do for our clients when the juice is worth the squeeze. For gambling losses, the rules have changed. In the past, you could offset 100% of your gambling winnings, or up to 100% of your gambling winnings with gambling losses. I had a client the other day that said, hey, Spencer, I had gambling winnings of $1,000. I said, great, we'll include that on your tax return. And he went into it and he's like, well, I won $10,000 and I lost $9,000. So I won at the end of the day, at the end of the year, I won $1,000. The problem with that is the winnings, the gross winnings are reported on one part of the return and the losses are reported on another part of the return. So therefore, I can't just know the net. I need to know the losses and I need to know the winnings. And what they changed is that limitation is only to the extent of 90% of your losses can offset your gambling winnings. Well, and so if you had $100,000 of losses, $100,000 of winnings, they would limit that $100,000 of losses to $90,000. So even though economically you are at a break even, you still have to pick up $10,000 of income in my example. Now, if you won $100,000 or had $100,000 of winnings and $1 million of losses, all of those losses could completely wipe out your winnings because 90% of $1 million is obviously greater than 100,000. So just some changes with gambling losses. With that being said, we are now going to focus on more of the business incentives and deductions, and I'll turn the time over to Mason.
So one of the big things that people were watching really closely was the bonus depreciation. So bonus depreciation has been around in one form or another since, I believe, 2001. And really allows for the quicker write-off, or the quicker taking benefit from buying capital assets and getting deductions for buying those capital assets sooner. Um, it was on a schedule that was actually phasing out as a result of the TCJA, the prior tax legislation. So 3 years ago it was 100%, 2 years ago it was 80%, last year was 60%, and this year was scheduled to be 40%, which means that if you have eligible assets, you can write off 40% of the value, or the cost that you incurred to acquire them in the year that you placed the asset in service. Well, the law has been changed, and bonus depreciation has been made permanent, but it's for property that's acquired and placed in service after January 19th, 2025. So that phrase is really important, acquired, because there's a lot of times that people have acquired property in prior years but have not actually placed them in service for the business use until current year. For an example, if someone bought a property and they were renovating it for a rental, they could have bought it in a prior year, they renovated it in a prior year, but they placed it in service in February of this year. Well, under the law, that property they placed in service, the elements that would be eligible for bonus depreciation would not be eligible for 100% bonus depreciation. They would follow the old schedule of 40%. So it's important to talk through those facts. If you have property that was acquired, don't just assume that it's eligible for 100% bonus depreciation unless you've acquired it this year. Some of the things to think about when it comes to bonus depreciation, it probably accelerates if you've been deferring the acquisition of equipment or machinery, maybe that's something you want to do this year if you have a tax liability, because you're able to take quicker depreciation on it. Another thing is if you have properties, real estate that you're using in a trade or business or renting, it might be worthwhile to do a cost segregation, which means looking at the building, which is a long-lived asset, maybe as long as 39 years, and looking at the components of that building, and if there's systems within that building, if that have shorter lives, moving them to a 15-year or less lifespan, which makes them eligible for bonus depreciation, and then taking those deductions in the first year. The important thing to keep in mind there is that the decision to take bonus depreciation, or depreciation in general that's accelerated, is really one of timing, right? Because it's like you're either taking a deduction up front in earlier years or later. So there's a cost benefit of what is the cost of actually doing a study and taking those deductions versus the benefit you're receiving. So something to keep in mind. Another big provision of the OBBBA is the research and experimental costs. So a lot of businesses incur R&E or R&D expenditures, research and development, sometimes referred to, that in the course of just developing products. So the TCJA, the prior legislation, actually had a sunset on a business's ability to deduct those expenditures in the year that they were incurred. Instead, required those businesses to then capitalize them and take the benefit of those costs over a 60-month period, over 5 years. So the tax law change reinstates accelerated write-off, just basically expensing the costs as they're incurred for domestic R&E expenditures. It's just domestic. Foreign research and experimentation costs are still subject to a 15-year recovery period. So again, this is one of the areas where the tax code is trying to encourage a certain behavior, and one of the things it's trying to encourage is domestic research and development expenditures rather than foreign. There is an opportunity here for small businesses. Under some circumstances, you're able to go back if they've been required to capitalize those expenditures in the prior few years. You can go back and amend returns to actually get the deductions in those years. Alternatively, for clients that don't qualify for that, or if they just choose to, they could take the benefit of that prior capitalized expenditures that they didn't get to recover and take the unrecovered portion over the next 1 or 2 years. So that's available. Another deduction item that was affected was the limitation on deductible business interest expense. So this is yet another provision that came about from the TCJA in 2017. But it basically, not to spend too much time on it because it's really more of an extension of an existing law, there's a limitation on your ability to deduct interest expense for businesses that are higher leveraged than other businesses. And now there's a more favorable calculation that got reinstated that allows you to look at whether or not the business is highly leveraged when you look at earnings instead of earnings after taxes and interest and taxes. You actually can look at earnings before depreciation, amortization, interest, and taxes. So it's a little bit more favorable for taxpayers, and it was kind of the rule that this law started out with. It's just been reinstated. 461L is a code section. There isn't really a handy term to use to shorthand it for people to understand. But this is a limitation that was started with TCJA, is not very taxpayer friendly, and is made permanent now. This limitation is for individuals and their ability to offset non-business income, so investment type income with business losses. So I'll walk you through a real quick example. So say you have an individual who has $1 million of non-business income, interest income, and $1 million of loss from rental activities or from their business. You would normally expect that $1 million of income, $1 million of loss, they offset, have zero taxable income. Well, 461L states that if you've got not a business income, your limitation this year for married filing jointly would be $610,000. You can only offset $610,000 of the investment income with that loss. The remaining $390,000 gets carried over to a future year to use in future years. So this is something that we were hoping would go away. It's just another one of those things where you expect an outcome, and tax law can throw a wrench in that. So again, it's probably another case of saying, really do a tax projection, work with your team to make sure that the outcome that you're expecting is really the outcome you're getting as time goes by. So next slide. QBI. So this QBI stands for Qualified Business Income Deductions. And this was, again, another provision that was put in place in 2017 with the TCJA. And it allowed pass-through entities that were operating trader businesses, specific trader businesses, like, but through a partnership or an S corporation structure, a flow-through structure, to take a deduction for a piece of their income. It's a 20% deduction. And the reason for this is really kind of like it's a targeted tax cut on that type of income to put flow-through entities on par with C corporations, because when TCJA passed, C corporations had a rather large tax cut there. The effective tax rate was 21%. And so giving partnerships and S corps this deduction kind of put them on similar footing so that you didn't have a bunch of people rushing into C corporation structures. So it was made permanent. It was set to expire. So the big news is that it's permanent now, so that everyone's happy about that. And then there's certain businesses that don't really qualify. So special service trader businesses are businesses that are generally professional service businesses, like think like law firms, medical, like doctor offices, accounting firms, engineers, so consulting companies. Those types of companies are considered SSTBs, and so they do not qualify the same way. There's income thresholds that limit the owner's ability to take those deductions, and those thresholds rather are rather low. They've been moved up slightly. Probably doesn't affect a lot of the families that we work with, but for lower income people, those since they've been moved up slightly, I think there's more people that are eligible. And there's also a minimum deduction for this too, where if you have limitations, people can still participate in this and get a benefit. But again, doesn't really move the needle. It's a pretty small amount. I think this reminds everyone to continue to review the pass-through entity structure, and for individuals to consider, making elections to the extent it makes sense to combine different activities in order to maximize the QBI deduction. Maybe look at salaries that are being paid, because one of the thresholds on whether or not you actually get the deduction looks to the business assets, and another looks to the W-2 wages paid. And so you want to make sure that you're taking the steps necessary to maximize your deduction, because it's a permanent difference. It's 20% deduction could be a really big deal for a lot of people. Business incentive structure, so structures. One of the things that we see a lot it was a big news because it was just such a radical change, was what they call a qualified opportunity zone program. So going back to the TCJA in 2017, the way the program worked was it allowed taxpayers that had a capital gain of whatever amount to elect to invest that amount. So just say it was like a $5 million gain I had incurred in, in 4 or 5 years ago. You could take that $5 million of gain and elect to invest it in a qualified opportunity zone fund. A qualified opportunity zone fund is it's a structure that invests in businesses in specific areas of the country, areas that are targeted for economic development. So you generally lower income areas, but by making those investments, the tax code allowed taxpayers to defer recognition of the gain. So instead of recognizing that $5 million of gain in the for 5 years, you also had a basis adjustment, which allowed you to not recognize the full $5 million. You could actually offset a big piece of that. And to even sweeten it further, if the taxpayers held those businesses that in those opportunity zone areas for 10 years, they could eliminate the gain on the sale when they exited those businesses. So 2020, the TCJA was kind of the first run through it, but it's actually been expanded. And it's been expanded beginning in 2027. So this is kind of the weird thing. A lot of people have heard about the expansion, but they don't know that the old rules still apply all the way up until December 31st, 2026. The new rules really kick in 2027 when new opportunity zone areas are going to be identified. So it's permanent. There's going to be a 10-year rolling period where they continue to look at reestablishing and resetting opportunity zones on a 10-year rolling basis. The deferral will work on 5-year periods. So if you were to say, I have got $5 million in 2027 and I'm going to invest it in a fund, you can do that and defer it for 5 years. So all the way until 2032. That sounds like a crazy date way out in the future, but until 2032. And then if you held it that long for that 5-year period, you get a 10% basis adjustment. So the $5 million of gain I deferred, I don't have to recognize $500,000 of it. It's 4.5 million. And they sweetened it a little further and said, in addition to that, if you invest in a business that's not just in an economically distressed area that's identified, but it's also a rural area, you can offset 30% of that. So instead of $5 million a gain, it's 3.5 million. So it's another benefit for people. If you hold that business for 10 years, again, you get to eliminate the gain upon exit. The downside is there's some stricter reporting and some bigger penalties involved for non-compliance. So another thing we see a lot of families take advantage of is Section 1202, qualified small business stock. So if you're creating a business and I'll tell you how the prior law worked. This is really for C corporations. If individuals and trusts had acquired C corporations stock in qualified small businesses in a qualified way, so stock that was issued by the corporation to them in exchange for money or services, and held that stock for 5 years, there was an exclusion that would apply upon selling it. So if I invested $1 million in the stock and held it for 5 years and sold it for $5 million, under the old rules, I'd be able to exclude, not recognize any of the gain, the $4 million of gain that's inherent in there. And the limitation was I could do that for up to $10 million per taxpayer. So per shareholder, basically. And the test is really a lesser of. I'm using the $10 million, but it really could be the, greater of $10 million or 10 times basis. I only invested $1 million in my example, so that would be the lesser of $10 million or 10 times a million. So 10 million or 10 million, so it's no difference. But if I had invested $1 million in that C corporation stock and sold it later, my threshold would actually be 20 million. So you can do the math on that. So what's changed since then is only applies to stock that's been acquired after July 3rd, 2025. And so that's key. If you have stock that you acquired beforehand from a qualified small business, old rules still apply. The benefit, though, for acquiring stock now is that you've got a phased in period of time that you're actually able to exclude income on the gain, on the sale. Before, it was all or nothing. If you didn't hold the stock for 5 years after acquiring it, you didn't qualify for 1202. It was taxable gain. Under the new rules, For stock that's newly issued, you have a phase in of you can exclude 50%, 75%, or 100%. So going back to my example, if you bought stock for $1 million and I sold it in 3 years for $5 million, I'd be able to exclude 2 of the $4 million of gain, right? 75 would be 3 of the $4 million of gain, and 100% would be I'd be able to exclude the full gain. The individual thresholds also changed. So for the $10 million is now going forward is $15 million per taxpayer for stock that's been issued. And that's a go forward basis as well. The one thing that really keep in mind with 1202 is it's very technical, and not only does the company have to meet the requirements, but the individual in the acquisition of the stock needs to meet the requirements, and you have to follow that process through to the sale. So really, you should involve your planner early on before issuing the stock all the way through the sale, because you want to make sure that you've got the chain of evidence that shows that the stock qualifies and the sale qualifies all the way through, because it's really hard to do when the company is sold to be able to prove that, because it could be many years down the road, and going back 10, 15, 20, 30 years gets to be really challenging. So having someone involved up front is really important in that. Okay, some of the stuff that's kind of like more like I think you've heard in the news, but probably doesn't apply to a lot of the families we work with. The no tax on overtime, no tax on tips. So one of the things I heard is I think people have assumed it just means no tax, but really those tax and tips are still subject to payroll taxes, so like Social Security and Medicare taxes, still subject to state income taxes, and actually still at the time of payroll, still subject to federal income tax withholding. Really, what the benefit is for people who have this type of income are they get to take a deduction. They get to deduct it out on their individual tax return. And so it works as a above the line or a deduction that's not subject to the itemized deduction limitation. However, the cap is pretty low, $25,000 for married filers, and the phase out, it's not really available for high income people. So it phases out completely by, if you have a married couple with $300,000 of income. One thing to note on the overtime portion of it, tips are specific industries that will be identified by the IRS. So it's got to be a specific profession that is normally customarily tipped. Overtime is really overtime that is paid more. So if you get time and a half for overtime, it's the half that you get to deduct out, not the time. So you can, if you work 41 hours and you got paid time and a half for that 1 extra hour, you only get to deduct that 50%, the half, not the 1.5. So. And then Trump accounts. So this is the other thing that I think we've heard a lot about, is the free money for kids. There's going to be accounts that are opened for children born between 25 and 2028. So it's available for children born those years, as long as they have they're U.S. citizens with parents with valid Social Security numbers. These accounts were actually part of a broader plan originally, to try and unify the different types of accounts that are out there, the tax favored accounts like 529 plans and IRAs, but that kind of fell apart early on. And so really what we're left with are these accounts that work for minors, for kids. You can set them up for kids and make contributions to them up to $5,000 per year for a kid up until they turn 18. And the money grows in there tax-free. But there are some significant downsides to this. One downside is the investment in those accounts has to be a US equity index. So you're limited like S&P 500 funds or like Russell 3000 funds. Another downside is any money that comes out, no matter what it's used for, is subject to ordinary income tax at the kid's rate. So unlike like a 529 plan, where if you pull money out and use it for education purposes and there's no tax, these are still going to be subject to income tax. Kids can start pulling the money out when they turn 18 if they use the money for qualified purchases. So that would be education, first time homes, starting a business. And if they pull that money out, it's still subject to tax, but it's not subject to penalties. If they pull out for a non-qualifying reason or before 18, and they don't get an exception for that, it's subject to a 10% penalty. And then they get full access after age 30. Again, I would really consider, if you're using a tax deferred account for a specific reason, to look at IRAs, 529 plans make a lot of sense. If you're looking at like investing, like even a taxable account has a lot of benefits in that you get capital gain treatment at the end of it and that you have more investment options. So these might not be a great solution for a lot of people. But if they're going to give you $1,000 to do it, take the $1,000, I'd say. Okay. Any questions?
Mason, with that being said, you mentioned the tax on tips. I think it's really important. I had this really shady character. He's my brother. He said, "Hey, I want to pay my kids, and why can't I just classify all the income that I pay them because they work in his business?" He gives them a W-2 and he says, "I'll just call them all tips. That's all tips." And then no, it has, like Mason said, it has to customarily be an industry that has tips. You can't just say everybody's income is tips now. The other thing that I've run into are the Trump accounts. I mean, you have to be born between 2025 and 2028 to
Mm,
get that $1,000. And I know a lot of people who are like, okay, this is great. Where's my Trump account? How do I get one? They haven't worked out the administration of that, I don't believe. Like they haven't figured out who's going to own or where's the account going to be? Is it going to be with the IRS? Is it going to be with Morgan Stanley? Is that, how's that going to work out? So nothing has been figured out, and I believe they will figure it out by June of 2026. That's when the accounts will start to be opened up and
right.
and things like that. So there's nothing you can do right now about those accounts. So anyway, just this couple of things that I've run into with clients about those updates.
Yeah, I mean, I think that's a good point that there's still a lot of details that are being worked out with this, and identifying which industries are eligible for being classified as tips. How the accounts are going to be set up. It's all still work in progress. I'm interested to see how the IRS is actually planning to implement some of these things because it's always interesting to see legislation passed and you're like, oh wow, let's see how they actually are able to administer this because it could be a mess.
One of the questions we got, Mason, and this may be more geared towards you because it applies to qualified opportunity zones, is what are your thoughts on gifting or sales of qualified opportunity zone interests to an IDGIT now that the rules have been extended?
Yeah, so I mean that's I think there's probably a lot of factors at play there, including like the overall estate planning strategy that you're pursuing. But I think that could be a valid option. So an IDGIT is really it's a defective grantor trust, intentionally defective grantor trust. So it's an estate planning tool that a lot of families that families that we work with use to transfer wealth, but at the same time remain the taxpayer. So you can create these trusts. You can transfer money into those trusts. The person who transferred the money into those trusts is no longer necessarily the beneficiary of those assets anymore, can't use them, but they're still considered the taxpayer. And the benefit of that is the individual is paying the taxes and their estate's being reduced. So it's almost like an indirect transfer of wealth into these trusts. And so the question is saying, what are your thoughts on gifting or selling QOZ interest to a grantor trust now that these rules have been extended? It could be a valid technique because if you're able to exclude on the back end the gain on the sale of those interests, I think it really comes down to the economics on is there really going to be upside or growth there? Because really what you want to do is focus on assets that are highly appreciating to get them out of your estate. And if they are not the highly appreciating assets, it might not make sense to do that because really you get more bang for the buck doing that. But again, you have to weigh that with what are the personal needs because you don't want to give away wealth that you're going to need over your lifetime. So it's a complex question. I don't think that there's a quick answer for it. I don't think that there's a obvious benefit either of doing that. So
The next question we have is what about the death tax? And I'll take that question. So when I say estate tax, death tax, transfer tax, they're all pretty much the same thing. So when you pass away, there's a potential that you'll pay a death tax or an estate tax if your estate or what you own is in excess of $15 million. And let's say you're single. If you're married, you get the one spouse gets $15 million and the other spouse gets $15 million. So as a married couple, you can pass away or transfer $30 million and not pay any death tax, not pay any estate tax. So there still is a death tax, there still is an estate tax, but what happened with the OBBBA is that that exclusion or that limit, the lifetime exemption is still $15 million. It was going to go back down to $7 million. So if you passed away with more than $7 or $8 million, then you would start to pay the tax. But they kept it at 15 million per person. And that was one of the concerns, one of the sunsets that lots of people were worried about. So,
One of the things I've heard about the death tax and estate tax from a lot of practitioners, and I see the point is it's really an elective tax, not elective in that you can just decide not to pay it, but elective in that if you start planning early enough, that you could easily get to a point where you don't have a taxable estate. So I think that if it looks like that you have a taxable estate, it's worth talking to your estate planning team to talk about, at least there's a plan for how to reduce that to the extent you can, if that's important to you. Again, you kind of have to look at what your individual goals are. So if paying the estate tax is something that you want to avoid, begin that conversation earlier the better, because time is your friend when you have done the planning early. Like you're able to actually, use the tools like grantor trusts in order to like wear down your estate with kind of chip away at your estate, and instead increase the assets that are outside of your estate. So that's something you need to do early. I see a question on, do you have any insight on the new qualified production property eligible for bonus depreciation? Do you expect regulations to be issued? That's a good question. I think that so qualified production property is property that's integral to the use of for manufacturing, and allows for things that wouldn't normally qualify for bonus depreciation, long-lived assets, to be eligible for bonus depreciation. So you can kind of think about like a manufacturing facility that was put in place in service, being able to write that off quickly. I think that there seems like there's going to need to be more guidance, because I think that there are some holes that in the legislation as it's written. So I don't know if I'd expect regulations, just given the shorthandedness of the IRS these days and how long it's taken to get regulations under the prior legislation, and now with the additional cuts, and from what I hear within the IRS, I don't know if I'd be holding my breath for regulations to be issued anytime soon. But I would hope that there would be more guidance as people digest the law.
yeah. The next question I really appreciate, because this does need clarification. It's, why do you consider the increase in the lifetime gift tax exclusion permanent? Can't it be changed by the next administration? Yes, it can be changed by the next administration.
Congress.
When we say permanent, what we mean is that it won't change unless there is an act of Congress. So there is no sunset. Some of these rules say this is going to be changed, and then it's going to sunset or change in 2028. When we say permanent, it means that it's not going to revert back to anything, or it's not going to be changed unless there's an act of Congress. So thank you for having us clarify that for sure. So that being said, I think, Mason, we're at an hour here, and that was the last question, I think.
I think there's one more. Any benefits for the first-time home buyer?
Oh,
I don't think there were any specific benefits other than the kind of what's already in place for home buyers, the ability to deduct acquisition indebtedness interest. So that's been there. So that threshold is still at $750,000 of acquisition indebtedness, being able to deduct the interest on that. There's always the home exclusion, which is if you live in your house for 2 years as a primary residence and then sell it, you're able to exclude $250,000 a gain, up to $500,000 a gain if you're married. So that's always there. I think those are the two big ones. So, but nothing else specific to home buyers that I'm aware of. How about you?
yeah. No, I don't think anything's changed there. So
Okay. All right. Well, thank you for spending time with us today. We hope you found the session both valuable and informative. To everyone watching, we really appreciate your interest and thoughtful questions that you shared. Uh, if we didn't have a chance to address your question, I think we got them all. But if there's other questions that you have, please don't hesitate to contact your TFO team to help you with that. On behalf of TFO Family Office Partners, thank you for joining us. We look forward to connecting with you in future webinars. Have a great evening.